Let us talk about how to calculate income tax on business. Don't you go anywhere. You're going to love today's conversation. I guarantee it.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flow with a stinging killer beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in.
Welcome back, folks, to another edition of the Awesome Sweaty Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Now let's roll. In today's conversation, I want to speak to you specifically about how to calculate income tax on business. And let me give you an overview first. What are small business taxes? So small business taxes include many different kinds of taxes that a small business is responsible for paying. So there are various payments that your business must take into effect when it comes to federal, state, or local government. So small business taxes can vary depending on your business entity and business location. So I'm talking about your legal structure or your business geography. So not every entity will have to pay taxes the same way, and certain states and counties and or municipalities, for that matter, will have different taxes on small businesses. It's important. And small businesses can be taxed in various ways. So the primary tax to deal with is the income tax. And some business structures must pay taxes as a business entity, whereas others allow business owners to pay income tax as individual taxpayers. Okay, so let's talk about business entity income tax rates. So the tax rates will vary depending on your business entity. So how is your small business organized and what kind of legal entity it is? Okay, so the critical factor here is whether or not the government recognizes your business as a pass-through entity. So a pass-through entity is a business in which all business income passes through to be taxed only on the individual business owner's personal tax returns. We're speaking about 1040 from 1040. So other companies must make tax payments on behalf of the business instead of letting the income pass through directly to the shareholders. Okay, so for C corporations, for example, C corporations must file and pay taxes on all of their business income according to the corporate tax rate. So there are then any shareholders who receive dividends will have to pay taxes on that money again when they file their own personal returns. So the corporate tax rate at the federal level in the United States right now is 21%. Okay, you have S corporation. S corporation can file paperwork with the IRS and elect to be recognized as an S corporation if they meet certain requirements. Okay, so the main difference between an S corp and a C corp is that an S corp is a pass-through entity. So the S corporation's income will pass through the companies directly to its shareholders, who will pay taxes on their income as individuals. You have partnerships. So partnerships are also pass-through entities, much like the S corporation. Therefore, each partner will pay taxes for their portion of the net business income at individual tax rate that range from 10% to 37%. Then you have sole proprietorships. So sole proprietorships are the most common small business entity. So sole proprietorships are not legally distinct from the business itself. So they will pay taxes at all if they have any taxes to pay on their business income at the personal level. Okay, so their income tax rate will depend on their particular tax brackets. But again, this range from 10% to 37%. Then you have LLCs. So LLCs, known as limited liability companies, are taxed according to how they file with the government. So LLCs can be taxed as an S corp or a C corp, but that's not the most common practice. Generally speaking, single member LLCs will pay taxes as a sole proprietorship. In contrast, multi-member LLCs will pay taxes as a partnership, both of which mean paying income taxes according to the individual's personal income tax bracket, because partnerships are definitely pass-through entities. Now let's talk about estimated tax. It's very important to understand this concept because it really plays into the whole calculation process. So why estimated taxes are important? You are probably a small business owner paying taxes as a sole proprietor, LLC owner, or partner. In these cases, you must pay your business income taxes through your personal tax return. This is called pass-through entity, as I explained before, pass-through taxation. So let's say you make a profit this year in your business. If you are an employee, you would have payroll tax deductions for income taxes due on your income, right? And here we're speaking about business and personal. But as a business owner, you are not an employee, so no taxes whatsoever on your income are taken. Okay, so but the thing is that the money is taken at the personal level, not at the business level. So you are also required to pay Social Security and Medicare taxes on your business income. So the combination of income taxes and Social Security, Medicare taxes on your business income is called self-employment taxes. So your payment to yourself as an owner are not considered a salary. They are considered an owner's draw, and taxes have not been withheld the way they would be if they were taken from an employee's paycheck. So this is where estimated taxes come in. You must pay quarterly estimated tax to avoid penalties and interest on late payments. Okay, so who must really pay estimated taxes? It depends. So when you consider whether you must pay estimated taxes, you will need to look at all into your income for the tax year, including any income from employment, not as a business owner, capital gains, and dividends. So the IRS says that you don't have to pay estimated taxes if you meet all of these three conditions. You had no tax liability for the previous year, you are a U.S. citizen or resident for the entire year, and your previous tax year was for a full 12 months. So you must pay estimated taxes if you owe $1,000 or more for the year, $500 for corporations over the amount of withholding from any salary as an employee, or refundable credits. Okay, so if you don't do this, there are underpayment penalties. So if you don't pay enough through withholding and timely estimated tax payments, you may be charged a penalty. You may also be charged a penalty if your estimated tax payments are late, even if you got a refund. Let's talk about payment timing because it is important. You can see on the screen a beautiful screenshot courtesy of our friends, our very smart friends at the Balance. So when we talk about payment timing, how and when do you have to pay estimated taxes? So payments are due 4 times a year. So the first payment is on April 15th, the second payment June 15th, the third payment September 15th, and the fourth payment January 15th of the next year. So if your income is steady throughout the year, you can divide your payments up to 4 equal payments. If your business is seasonal or you have a change in your business income, you may have to take smaller or larger payments into 1 or more quarters. It really depends. So you can use the quarterly vouchers included in IRS Form 1040-ES to make these payments. If you use a tax preparer or tax preparation software to prepare your tax return, they will include an estimated tax calculation and copies of vouchers. You must make the payments yourself in 1 of 3 ways. Mailing the payments with the voucher. You mail in the payment with the voucher. You can pay online using your credit or debit card through the IRS Direct Pay, or you can pay by phone. So you want to see Form 1040-ES for copies of vouchers and details on those vouchers and other payment methods. Okay. One thing I want to say here is that it's very important. You can make additional estimated tax payments to make up for a quarter with more income, and you can also make your estimated payments weekly, bi-weekly, or monthly. As long as you have paid enough by the quarterly due date, then it's fine. It's easier to make these payments online through one of the IRS approved payment methods. Okay, but the whole thing here is that you want to get advice from an expert. I mean, there is no simple solution or easy equation for calculating and paying the entirety of your small business taxes. A lot will depend on your location, business structure, and the nature of your business. Okay, so however, taking care of your tax obligations and planning carefully for the money you owe may be a time-consuming and essential task. The thing here is that you want to invest in the stability and efficiency of your business by working with a tax accounting expert who knows the specific laws that apply to your business and your location. Okay, so working with a professional with knowledge of your context and situation is the only way to get real and reliable information on what you should expect. So when we talk about a knowledgeable accounting expert, tax accounting expert, we are speaking about a CPA, for example, a certified public accountant, a tax lawyer, for example, or even an EA, an enrolled agent. let's talk about the relevant data that really apply to paying income taxes. This is very important. Now, so here is some information needed for the estimated tax calculation. So to calculate estimated taxes, business taxes from Schedule C, you will need to combine this business income with information on other income, tax withholding, deductions, and credits on your personal tax return on your 1040. You will also need to calculate self-employment tax, Social Security, Medicare taxes for business owners, and include self-employment taxes in actually determining estimated tax due. Okay, and the cool thing here is that when you estimate your taxes for the year, you want to include all sources of income in addition to your business income and self-employment tax, including salary, tips, pension, dividends, alternative minimum tax, winnings, prizes and awards, interest, and capital gains. This is really important. And here is a list of the information you will need. So you will need an estimate of your business income for the tax year. And you can use your income from previous years or take your income up to the current date and estimate income for the rest of the year. You can extrapolate. Okay, you will need also an estimate of business expenses for the year using previous years as a guideline or using year-to-date expenses and projecting them through the end of the year. Another form of extrapolation. So because your estimated taxes depend on your personal tax situation, you will need to include personal income, deductions, credits, exemptions, and any withholding of federal income taxes from your personal income. So in the same way as business income and expenses, you can actually use information from prior tax returns or use year-to-date and project to the end of the year. The whole thing here is about doing what I call an educated guess. You want to do an educated guess, making sure that the estimation or extrapolation that you engage into makes sense in relation to the data from last year and the data that you have accumulated so far this year. So this is really important. And the cool thing here is that you want to make sure that you pay enough money. It's better to overpay than underpay because of what I just told you earlier. There are penalties for underpayment. Let us dig a little deeper into tax calculation because this is something that a lot of folks have asked us to really elaborate on. So when we talk about estimated taxes, here are some calculation methods. So you can calculate your estimated tax payments by asking your tax preparer to run an estimate, by using the IRS estimated tax calculation worksheets, or by getting a rough estimate from your previous year's return prepared with tax software. Okay, and the thing is, you can use the estimated tax calculation worksheets provided by the IRS on Form 1040 ES or the worksheets included in Publication 505. Corporations usually use Form 1120W to calculate their estimated tax. So you can use tax preparation software. That's what we have seen. It's a lot easier to use tax preparation software because you can use that software to run a rough calculation of estimated taxes for the next year. If you use the same software every year, you can start with last year's return for information. So the tax software tool includes self-employment taxes, and if your business and personal income are fairly steady from year to year, the software will provide a rough estimates for tax planning purposes. Okay, so what about estimated taxes for partnerships, LLCs, and S corporations? Well, owners of partnerships, LLCs, and S corps are not employees of the business. I've said this before, I'm going to say this again. They're not employees, so they receive payments periodically from the business, and these payments are added to their personal tax returns. So these payments are not subject to withholding, so estimated taxes may need to be paid. So to calculate estimated tax payments, you want to use the process that we actually described a little earlier. Again, the bottom line here is what? The bottom line is, if you are confused, if you need more help, if you need more guidance, you can either drop us questions below, ask us all questions. Our team stands ready to answer you. But most importantly, and even better, you want to get the advice from an expert, because your business depends, your business taxes depend on your geography, depend on your business structure. Okay, depends also on the kinds of activities that you engage in. So an expert, a local CPA, a local tax attorney, or an enrolled agent will be better suited to advise you. Let us talk about IRS compliance. But before I do that, I'll be right back right after this. Don't go anywhere.
Finest, yeah, 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 Mr. Killer, and call me señorita. Ay, papi, got me dreaming. My legs up on the ceiling. Oh, yeah, yeah, yeah. I know when he come, he ain't never gonna leave now. Hit it the night run, and that's the way I wanna be. So don't think I'm the one to won't ever be enough.
Welcome back, folks, to another edition of the Awesome Sweaty Kiwi Show. I hope you're still there. We are speaking today about how to calculate income tax on business. And I want to talk to you about IRS compliance. Okay, this is very important. And so as a small business owner, your net income is the primary information you'll need for calculating your tax liability. So then there are two more main factors you will want to consider to figure out how much you owe in income tax. So you'll pay more than you're supposed to if you don't claim the proper tax credits and deductions on your tax returns. So we have tax credits. So tax credits are a valuable way to reduce taxes for small businesses. Using tax credits those credits simply reduces your tax liability because they effectively serve as a payment from the government to cover part of the tax you owe for the previous year. So there are over a dozen tax credits available for businesses, so be sure to take advantage. You also have tax deductions. So on the other hand, tax deductions lower your taxable income before calculating the total tax you owe. This means that deductions can even bring you down into a lower tax bracket if your income is right on the threshold. You can deduct many or all of your regular and necessary business expenses from your income if you run a business. This can reduce your taxable income considerably if you make sure to keep your receipts and record all of your eligible business expenses. Some deductions even let business owners deduct the costs of new or depreciated assets. This is just fantastic. But again, I want to emphasize the fact that we are giving general guidance here. We have no idea about your business's geography. We have no idea how legally structured your business is. We have no idea of the context, the regulatory context in which you operate, your business operates. So it's always important to enlist the help of a trusted expert, of someone who understands the local subtleties of taxes, and not only locally but also federally. Okay, you want to reach out again to an accounting expert who knows the specific laws that apply to your business and your location. So working with the professional with knowledge of your context and situation is the only way, in our view, to get real and reliable information on what you should expect, unless you have some knowledge of business taxes yourself. Beyond the IRS, it's really important to also pay attention to other taxes. Okay, so business taxes they do exist beyond federal guidelines. So when you think about small business taxes, federal income tax may be the first thing you think about, but that doesn't mean that it's the only tax you need to worry about. When it comes to tax calculation and planning for your company, there's a lot you need to keep on your radar. So you have state income taxes. So most states have an additional income tax for individuals and businesses within their borders, but the rates and different policies for businesses and individuals will actually vary widely. So 7 states don't charge income tax at all, and 2 states only charge tax on investment income. So you will need to look into your own state's policy to see what taxes you may be subject to. Your state might use a progressive tax rate like the federal government, or they might want to use a flat tax rate. Okay, so you are also likely to need a state ID, a state tax ID, no matter the shape of your particular state income taxes. So when we talk about the state tax ID is pretty similar to your federal EIN. Okay, so you need to think about gross receipts tax. So there are 10 states with a gross receipts tax, which is a flat rate tax on businesses. It taxes businesses at a flat percentage of all income they receive, because it is calculated according to gross income, not net income. This does not include any deductions for business expenses. So this tax functions like a sales tax, except that the business is expected to actually pay for it, not the customer. Okay, so the rate for this tax is generally lower than the normal income tax rate, but it applies to all sales made by that business. You also have to think about payroll taxes. So those are taxes imposed as a percentage of employees' pay. Okay, very important. There are federal and state payroll taxes, and some are paid by employers directly, whereas employers pay some with the money withheld from employee wages. You also have self-employment taxes. I spoke about that before. So if you're not an employee on someone else's payroll, you'll still have to pay many of those same taxes, including Social Security and Medicare taxes. Okay, this is what's also called a self-employment tax. And we also have excise taxes. So excise taxes are extra charges imposed by the government on certain specific products or services. It will only apply if you manufacture or sell certain products or use various equipment or facilities subject to one of those taxes. We have covered this on other shows. You also have sales taxes. Now, sales taxes are imposed directly on the sales of goods and services. There is no federal sales tax, but many states and municipalities set a sales tax at different rates. Okay, you will need to know how your state handles sales taxes, and if you need to collect a sales tax determined by your state or municipality, you will then need to remit those taxes to the proper authorities regularly. You also have a property tax, and property tax is exactly what the name suggests. This is a tax imposed on property you own, usually determined by the size and value of that property. So this varies widely by location, but it can represent a high cost for businesses that own real estate. Thank you so much for your attention. This is it for today's conversation. So I was talking to you briefly about how to calculate income tax on business. So I gave you an overview. We spoke about estimated taxes. We spoke about payment timing, relevant data, tax calculation, IRS compliance, beyond the IRS, all the other taxes that actually revolve around your business. Thank you so much. God bless you. I'll see you another time. Until then, remember, stay marvelous.